Okay, let's dive into this. Welcome to The Explainer. Today, we're taking a completely fascinating journey into the literal mechanics of turning small, everyday savings into massive, generational wealth. We're going to break down some deeply ingrained cultural habits about money, unpack the actual mathematical realities of different asset classes, and explore the psychological strategies that separate successful long-term investors from those who, well, constantly miss out. Our source material today draws heavily on insights from financial expert Deepak Wadhwa. And let me tell you, he offers a really powerful reality check on how we traditionally view investing. So here's our psychological roadmap for today. We'll start with the 100 crore formula, tackle the property investment myth, pivot to digital assets over bricks, explore the power of discipline, and finally wrap up with start small, think big.
All right, let's jump right into section 1, the 100 crore formula. 100 crore rupees. I mean, just let that number sink in for a second. For most of us, this looks like a lottery jackpot, right? Or maybe the net worth of a corporate titan. It honestly feels entirely out of reach for the average person earning an average salary. But according to the financial principles we're unpacking today, this number is absolutely not a fantasy. It's actually a mathematical endpoint of a very specific, disciplined process.
So how exactly can a 17-year-old turn just 1,000 rupees of monthly pocket money into 100 crore rupees? Well, financial expert Deepak Wadhwa points out that this is entirely possible. How? Through a simple systematic investment plan, or SIP, in mutual funds. Think about it. If a young person starts investing just 1,000 rupees a month in a fund returning around 15% to 20%, and, this is the kicker, leaves it untouched for 60 to 70 years, the absolute magic of long-term compounding pushes that tiny initial capital straight into 100 crore territory. It's mind-blowing, really. Time, not capital, is the ultimate multiplier.
Which brings us to section 2, the property investment myth. Let's talk about our deep cultural obsession with physical land. Wadhwa lays out what we can call the primary home role. And look, he completely validates the emotional need for a house. You should absolutely buy one home for your family's security. And if you have to take out a mortgage or a loan to secure that peace of mind, do it. It's your sanctuary. But, and this is a massive but, you must stop there. Buying a second, third, or fourth property with the expectation that it's your absolute best path to wealth generation, that is exactly where the math starts to break down. To highlight why treating real estate as a primary investment vehicle is flawed, Wadhwa uses this brilliant analogy. He asks, if I have a 1 crore rupee property and need 10,000 rupees, will I take out a window, sell a tap? It's pretty funny, right? But it perfectly hits the nail on the head regarding the severe illiquidity of real estate. Your wealth is literally trapped in concrete. Now, what's really interesting here is the stark reality of property investments. Just take the entry barrier alone. You can't just buy a tiny slice of a property. You need a massive chunk of capital, like 1.5 crore for a standard flat in a place like Noida, just to get a seat at the table. Then there's liquidity. If an emergency strikes, you definitely cannot liquidate a property in a day, or honestly, even a month. And finally, transparency. The real estate market often carries a surprisingly high risk of fraudulent documents or dealing with, let's just say, unreliable intermediaries. It is a really high-friction asset class. Okay, let's pivot to section 3, digital assets over bricks. Before we really get into the weeds, we need to understand the ultimate metric of wealth, the 10-year CAGR, or compound annual growth rate. This metric is absolutely crucial because it completely ignores the daily panic of the market. It gives you the steady, annualized rate of return over a full decade. It smooths out all that short-term noise and shows you the true, actual momentum of your investment. This is exactly how the experts measure real growth. And when you apply that 10-year CAGR metric, the contrast is just undeniable. Historically, property returns sit around an annualized 9%. But stock market indices and strong mutual funds, they've historically shown a 10-year CAGR ranging from 17% all the way up to 20%, and sometimes even higher. Now, when compounded over decades, the mathematical gap between a 9% return and an 18% return is frankly astronomical. Digital assets are simply outperforming bricks by a massive margin.
Let's talk about entry barriers for a second. Traditional property is basically an exclusive club. You need that 1.5 crore, which usually means taking on massive debt and spending the next 25 years of your life paying it off. But digital assets, they offer a complete democratization of wealth. There is virtually zero barrier to entry. Literally anyone, regardless of their income bracket, can start a mutual fund SIP which is 500 rupees or 1,000 rupees. It invites absolutely everyone to participate in wealth creation from day one.
Remember that window analogy from earlier? Well, this is the liquidity advantage in action. With real estate, all your capital is locked up. It's the whole shebang or nothing. But with mutual funds, you have the incredible power of fractional withdrawal. If you have 1 crore rupee invested in digital assets and you urgently need 5,000 rupees, you just click a button. You sell exactly 5,000 rupees worth of units, and the remaining 99,95,000 rupees just keeps working for you totally uninterrupted. It's pure convenience.
All right, moving right along to Section 4, the power of discipline. So the crucial point here is the psychological double standard we all seem to suffer from. When we buy physical property, we confidently hold it for 10 or 15 years without ever checking its daily price, right? Yet, the very moment we buy mutual funds, we're checking our phones daily, panicking at a tiny dip, and selling at a loss. We treat massive, illiquid investments with immense patience, but we treat our highly liquid, profitable digital assets with pure anxiety. It's crazy. And this anxiety absolutely ruins portfolios because of what we can call the mutual fund patience cycle. Wadhwa explains it like this. You might invest, and in year 1, the market dips and your portfolio drops 5 to 10%. In year 2, maybe it drops another 10%. The impatient investor, they sell right here, taking a total loss. But if they just held on to year 3, the fund might surge upward by 50%. By exiting early during temporary underperformance, panic sellers completely miss out on the massive long-term jumps in value that actually generate that juicy 20% average CAGR. This brilliantly illustrates Wadhwa's core philosophy. He states, "The game is not chasing profits. The game is knowing what I am willing to give to the market." Think about that. No one can predict if a stock will go to 1,000 or drop to 80 in the short term. The true engine of wealth isn't trying to time the perfect entry and exit points. No way. It's about knowing your risk tolerance, maintaining your discipline, and just letting the market do the heavy lifting over decades. And that brings us to our final segment, Section 5, Start Small, Think Big. Let's distill all of this into exactly what you should do next. Even if you lack specialized financial knowledge, you really don't need to overcomplicate things. The formula is remarkably clear. Step 1. Secure that one primary home for your family's peace of mind. Step 2. Start a mutual fund SIP immediately, whether it's $500 or $50,000. Step 3. Delete the apps off your phone if you have to, but ignore the daily and monthly market noise. And Step 4. Hold consistently for decades. That's it. That is the blueprint for wealth without the constant stress of being a daily trader. Let's move to a new framework and see how this builds. Ask yourself, would you panic and sell a plot of land 2 months after buying it just because the market felt a bit slow? Of course not. You'd hold it. You need to take that exact same unbreakable patience, that exact same property holding mindset, and apply it to your mutual funds. Treat your digital assets exactly like a plot of land you absolutely refuse to part with. So, we've unpacked the data, we've seen that the 10-year returns heavily favor the digital market, that the entry barriers are practically non-existent, and that the only real obstacle is our own daily impatience. So, I leave you with this final thought. You know the math now. Will you stick to the comfortable yet much slower illusion of physical bricks, or are you ready to build true generational wealth through the power of discipline? Think about it. Thanks for joining me on this explainer, and keep learning,